Snow. Along with burning crackers and enjoying this festival, I wish all of you to light a lamp of love, blast a chain of sorrow, shoot a rocket of prosperity, fire a flower pot of happiness. On behalf of Bangalore branch of SARC of ICA, wish all of you and all of your family very happy Deepavali festival. Today we are having a presentation on the topic Transfer Pricing Compliance, Form 3 CEB, Master File and CbCR. We have with us CA Ruby Thomas and CA Umesh Rao to present on this topic. I now request CA John to kindly come forward and escort our speaker onto the dais. I also request CA John to kindly welcome our speakers while presenting the floral bouquet. Big round of applause, ladies and gentlemen. Thank you, sir. Please be seated. To briefly introduce about our speakers, CA Umesh has more than 10 years of experience in practicing the Indian transfer pricing regulation, wherein he was extensively involved in addressing the transfer pricing issues faced by the Indian subsidiaries of foreign MNCs as well as issues faced in foreign operations of Indian MNCs. Mr. Umesh is Director of Transfer Pricing Department in Deloitte Haskins & Sells LLP. He has assisted the MNCs and the Indian companies in the transfer pricing litigation, planning and transaction structuring, mutual agreement proceedings and advance pricing agreement proceedings. Umesh is Commerce graduate and is also member of Indian Institute of Chartered Accountants of India. With this brief introduction, I welcome you for today's seminar. To briefly introduce about CA Ruby Thomas. CA Ruby is Manager with Transfer Pricing Practice at Deloitte, India and has 6 years of experience in assisting global MNCs on transfer pricing documentation, structuring, pricing audits and litigation. Ruby has assisted companies in end-to-end dispute resolution commencing from drafting of robust strategy to representation before appropriate authorities. She was also involved in assessing the readiness of companies in going in for an APA based on the detailed functional analysis and evaluating the extent of potential exposure in an APA. Ruby has recently co-authored an article in the Transfer Pricing, an international publication on transfer pricing. Ruby is Commerce graduate and a Chartered Accountant. With this very brief introduction, I welcome you for today's session. Over to you.
And thank you for coming for this study circle meeting, and Divya, thank you very much for the introduction that you have given. As Ruby Divya just described, my name is Umesh and I'm a director in Deloitte Haskins & Sells LLP. I've been practicing transfer pricing since 2006. That was the year when the transfer pricing was just started. 2002-03 assessments were just coming up, and we had rounds of transfer pricing experiences with tax officers. Life, if you ask me, was pretty peaceful there because you just had to focus on the compliance part of it and then representation before the transfer pricing officers. Not many cases were getting referred to the next level, that means to the CIT appeal at that point in time, and then onwards to the ITAT. So it was just the beginning of transfer pricing in India. Things were just unfolding. But if you see how the transfer pricing has grown over the period of time, it's just astounding. When the law started way back by Finance Act 2001, and assessment year 2002-03 was the first year of transfer pricing. Not many were aware of transfer pricing regulation, how it will unfold, what kind of documentation needs to be maintained, what kind of compliance needs to be maintained. Searching for comparables and then economic analysis itself was a process in itself. Not many were exposed to. So since then, all that one had to do was prepare a transfer pricing documentation, as mentioned under Section 92D with Rule 10D, and then obtain an accountant certificate. Then over the period, as the Finance Act as each budget came, there was we can see that there was a slight growth in transfer pricing year after year. We started with transfer pricing documentation. Today we have a master file. Today we have a country-by-country report to be maintained for certain companies which reach a revenue threshold of a particular number. So after that, if you look at that's primarily on the compliance side. If you look at on the assessment side, we started with the simple process of the assessing officer invariably had to refer the transfer pricing, the international transactions to the transfer pricing officers for audit. Who transfer pricing officer was categorized as a special officer to look after transfer pricing proceedings. So he had to refer the matter to the transfer pricing officer if the total value of international transaction exceeded 15 crore. As you can imagine, not many cases were getting referred to the transfer pricing officers, but if you see now, not many cases do get referred to the transfer pricing officers because the law has changed to a process where instead of having automatic referral to the transfer pricing officers, now you have something called a risk-based assessment, where the assessing officer, based on certain parameters, will decide first whether this is a fit case to be referred to the transfer pricing officer. Based on his risk assessment, the cases are now getting referred to the transfer pricing officers. So while the number of cases seem to have reduced to the transfer pricing officers, the intensity of transfer pricing audit, as we see, has increased substantially. Some of you may be practicing chartered accountants who have experiences in transfer pricing. You may be aware of what kind of transfer pricing orders are coming nowadays with a very high pitched assessments being posted. Now that's on the reference to the transfer pricing officers. But if you look at how the first level of appellate authority or the dispute resolution is going, it was a simple process of getting referred to the CIT appeal. The CIT appeal had to decide, whether there is the transactions are at arm's length or not, and then if you have a negative order, you had to go to the income tax appellate tribunal for a ruling. But later, as you would have observed, the DRP, the dispute resolution panel came in. Now the SSCs had the option of either going to the CIT appeal or go to the DRP, and then from there onwards to the income tax appellate tribunal. Along with that came the advanced pricing agreement, because the number of cases getting adjusted year after year and the quantum of adjustment over the period increased so much that the advanced pricing agreement had to come in some way or the other, so that there is a speedy resolution of cases and the business gets certainty at the end of the day. So these changes, as we observed over the period of time, had come in transfer pricing, and of course the transactions probably had also increased, the level of scrutiny had also increased. Just to mention, earlier references to the transfer pricing officers were primarily on whether the comparables selected were right or not, whether the margin applied by the taxpayer is right or not. Nowadays you get referred to the transfer pricing officers for issues like what is the AMP expenditure, the advertising, marketing and promotion expenditure incurred, whether those expenditures are in international transactions or not, and whether there has to be a compensation specifically for those transactions. So as we see, over the last 10 years, it seems like transfer pricing has grown in terms of complexity, in terms of the compliance probably also has increased a lot. What I feel is that the first level of documentation, if you keep it, if you keep a sufficient set of documentation to defend the transaction at say the TPO level, then probably that will help you in going to the next level. The beauty of transfer pricing is that it's so fact-based that unless you maintain the documentation right at the time of say preparation of Form 3 CEB and then and the transfer pricing documentation, it's likely that when the case comes up for audit after 2 years, it's likely that most of the people either would have left the organization, or those who are prepared would not be aware of what those transactions were. Why did we take that call on a particular transaction? Why did we apply a particular transfer price? So it's important that when we are preparing the documentation, at that point in itself, we better have the supporting documents kept and maintained in a file so that the risk of transfer pricing audit and the litigation subsequently is reduced. So what we are going to do today is we are going to talk about the preparation of Form 3CEB and briefly touch upon transfer pricing documentation, and subsequently we will touch upon the requirement of master file and country by country report, which is the second round, second cycle is actually ongoing as of now. The last year was the first round for preparation and maintenance of master file and CbCR. So I'll hand over the dais to Ruby, who is my colleague in our office and who has extensively worked on maintaining transfer pricing documentation and compliances for many of the companies. Thank you.
Thank you, Umesh. So what I will be doing here is I will just take you through the requirement, the documentation as well as the compliance requirement that is under the transfer pricing regulations in India, and then specifically focus on the reporting in Form 3CB. So as you all must be aware, all companies having international transaction will have to furnish a Form 3CB. And the due date for filing of that Form 3CB right now is 30th November for 2018 for financial year 17-18. In addition to that, along with the Form 3CB that needs to be furnished, a transfer pricing documentation also needs to be maintained by the company. Form 3CB is furnished by the company but certified by a chartered accountant. So it's certified by a chartered accountant and approved by the company, while the owners of preparing and maintaining the transfer pricing documentation rests with the company. Then, as Umesh mentioned, the new regulations in relation to master file and CbCR has come in, and there is a requirement to file the master file in India again by the due date of filing of return of income, which is 30th November. Of course, there are certain nuances around what to do if there are multiple entities, which Umesh will touch upon at a later point. In addition, there is another thing called country by country report that has come in, which is also part of the OECD BEPS action plan, which also needs to be filed in India in case certain criteria is met. Again, as I said, Umesh will touch upon that.
So, before we get into the transfer pricing compliance procedures and the requirements, how many of you have transfer pricing experience, either as a practicing chartered accountants or as part of the industry, so that we can then accordingly customize our presentations.
Thanks, Umesh. So basically, as Umesh said, the context, the thing that is changing in the world right now, or at least in the transfer pricing world right now, is that there is increased documentation requirement in the form of a local file, master file, as well as a CbCR. There is increased scrutiny by the tax authorities, and in addition to all of that, there is increased accessibility to data also. The tax authorities are reaching out to their counterparts in other countries to get information, which brings a greater onus on each one of us to make sure that everything that we report, everything that we maintain, every assistance that we provide to the client is foolproof or robust, in the sense that at the end of the day, the officer or a transfer pricing officer who looks at the document will take that as a basis for anything that he wants to propose, any analysis that he wants to propose. So the contents of a transfer pricing documentation, as you all may be aware, it has background on the company and as well as its group structure. Basically, the group structure, what does the Indian entity do, the industry in which Indian entity operates, and the profile of the associated enterprises with which the Indian entity has had transactions. Then you need to give the financial related information, such as what are the international transactions,
what was the transfer price, how was it computed, and so on and so forth. The third part, which is the most important part of a transfer pricing report, is the function analysis, and which is a very fact-specific analysis for each of the client, which will encapsulate exactly what what function the client or your entity and the associated enterprise undertake for each of the international transactions. That's one thing. So we will document the functions and the intensity of the assets and the extent of risk borne in relation to that international transaction. Once we do that, we undertake an economic analysis, and it can be in any form. There are 6 methods, as all of you are aware. We undertake an economic analysis, and this economic analysis is very closely based on the functional analysis and our findings there. Because at the end of the day, if you are finding comparable companies, you are trying to ensure that they are as functionally comparable or closely comparable to our on assessee or tested party. And then there are other documents like intercompany agreement, invoices, and anything to evidence that their services have been received and payments have been received, and so on and so forth. So that is the contents of a transfer pricing documentation that needs to be maintained. Now this transfer, as a chart accountant, as you are all aware, in the Form 3CB what we do is that we certify that it's true and correct. And to certify that it's true and correct, we need to have a basis. And this transfer pricing documentation will be the basis of us certifying that the Form 3CB or the amount disclosed in the Form 3CB is true and correct, and that we believe that the transactions are at arm's length. So I'll just move on to the contents of a Form 3CB, and then we can take questions after that. Yeah, so this is the opening page of the Form 3CB, where we say that we have examined the accounts and records of the entity, and that we believe that all the prescribed documents have been kept, which is essentially transfer pricing documentation under Section 10D and Rule 10D, and that we believe that the particulars that we are furnishing are true and correct, not fair, correct. That is the onus that each one of us have, is to certify that it is absolutely correct. Now a Form 3CB is divided into 3 parts. Part A, which has the general information, Part B, which deals with the international transactions, and Part C, which deals with the specified domestic transactions. Now Part A is a relatively simpler, it is just the basic information about your entity or your client, which is name of the assessee, PAN, address, nature of business or activities of the assessee. Ideally that should be in sync with what we give in the tax audit report and the ITR 6. There is a listing that will come which should be in sync. Status, whether it's a company, LLP, previous year ended assessment year, aggregate value of international transactions, and aggregate value of specified domestic transaction. Now of course as we prepare the Form 3CB, there will be certain instances where you may report a transaction out of abundant caution, but you don't believe that it is an international transaction. So do we add it here? Do we not add it here? Those are questions that will come up, and we'll take it up as it comes. Like just 2 points that we have put up here is if a taxpayer does not pass an accounting entry, but however suo moto volunteers it in the income tax return as well as in the Form 3CB, should it form part of aggregate value as per books of accounts? I mean, any thoughts on that? Should it form part of aggregate value books of accounts?
Yes.
And because?
Because ultimately you are passing the entry.
Yeah.
Based on the DT calculations. So you are accepting it.
Yeah, there are 2 things here, and it's just my opinion here, that books of accounts, is it tax books of accounts or is it company books of accounts? That's one thing. I mean, for tax purpose, at the end of the day, you look at tax books of accounts, and if you're offering it, shouldn't you be adding it? Second thing, with the onset of secondary adjustment and all, eventually any tax adjustment will have to result in a corresponding entry in the books of account anyway. So maybe that question eventually will come down that you will eventually have to pass that entry in the books of accounts. The another question that we had is, in case of within the company transaction, it has 2 units and under SDT you are reporting it, do you have to report both the units, or is it sufficient to report 1 unit? Essentially, because it it is the same transaction, a sale and a purchase, we would think that one transaction would be sufficient. A reporting of one leg of the transaction would be sufficient because it is within the entity. Any thoughts?
Within the entity, the transfer pricing does not apply, right? Because it's a PAN based.
In specified domestic transaction,
Okay.
what happens is that
between okay.
tax deduction, deductible
Between
unit and a
BOU.
yes. So then this might happen. This may not happen in a international transaction scenario. This will happen in a specified domestic transaction scenario.
And just on the
Just on the first question, my view is that there are two columns that come in Form 3CB. One is as recorded in the books of accounts, and the second column that asks for is what is the arm's length value of that transaction in the Form 3CB. So the moment you write, say 100 is the book value that you have recorded, but when it comes to what is the arm's length value, even though you have offered it as a suo motu adjustment in your return of income, I guess you will anyway write, say for example 110 as the value of that transaction. I'm not sure now that because of electronic filing which column it will take for disclosure in the front page, but I guess it takes the adjusted value as disclosed in the arm's length column value. Probably it will address your question on whether the aggregate value should be considered or not.
Now we move on to the part B, which is in relation to international trade.
Previous question, what is the conclusion for the second question?
One line.
One line.
Yes.
If you look at the institute guidance on issuance of Form 3CB, it actually just briefly touches upon this aspect. What it says is just be mindful of situations where a particular transaction may have to be reported multiple times. A classic example is this actually, where inter-unit transfer under various clauses you may have to report. You have either two options. One, report it in one clause and maybe make a note of that in the Form 3CB itself, saying that it's already reported there, or you just disclose that here itself. It does not conclude per se in the institute guidance. It says that just be mindful of this situation and take a judgment, professional judgment on how to disclose. My view is, if you disclose it at one place saying that this is the transaction made to that entity, and if you put a notes to that effect saying that this is the transaction reported and make that disclosure, I think that should be sufficient.
Thank you, Umesh. So I'll move on to part B, which encapsulates the reporting of international transactions. So basically, we have clause 10 to 20 that deals with international transactions. Clause 10 being the simplest of all, where you list out all the associated enterprises with whom your client or your assessee has had international transactions, and that involves the name of the associated enterprise, the nature of relationship, and brief description of what is the business that is carried out by the associated enterprise. Then clause 11 actually deals with tangible property. Basically purchase, sale, lease of tangible property, and clause 11 is again subdivided into three. 11A, which deals with raw materials or material in connection with manufacturing process. 11B deals with finished goods of traded products, and 11C deals with any other tangible property. Purchase, transfer, lease of any other tangible property. Clause 12 deals with intangible property, and 13 with provision of services, either receipt or provision. Clause 14 deals with lending or borrowing of money. 15 with guarantee. 16 is in relation to issuance, purchase of marketable securities, issuance of share capital, optionally convertible, partially convertible or compulsory convertible debentures or preference shares. Clause 17 is any other mutual agreement for allocation or apportionment of cost. 18 deals with business restructuring, and clause 19 is a residual clause which says that any other transaction which has a bearing on profit, income, loss or asset of the company. And clause 20 is a international transaction where certain transactions with unrelated parties are construed to be an international transaction and needs to be reported. In majority of the clauses, the reporting requirement does not vary. It is name, which means the name of the associated enterprise, the address of the associated enterprise, what is the transaction, for example, if it's service, rendition of services, if it's purchase of goods, what is the amount as per books of accounts, what is the ALP that we have determined, and what methodology did we use to determine that ALP. It is in this context that the transfer pricing documentation becomes extremely relevant, because how are you going to certify that this is the arm's length price if we haven't had a documentation in place, or which method have you used? So these are the requirements in most of the clauses, although certain clauses does not have the requirement of disclosing the amount computed by the taxpayer having regard to the ALP, and we will get into those clauses. But otherwise, the disclosure requirement in each of the clauses are consistent. Yeah, so as I said, clause 11 deals with tangible property, and while the clause A and clause 11A and 11B is quite self-explanatory in the sense that it deals with raw materials or finished goods or traded goods, clause 11C is a residual clause essentially. So any tangible property, it can even be a furniture. So it says international transactions in respect to purchase, sale, transfer of any other property or lease or use of such property, including transactions specified in explanation 1A to section 92B2. And explanation 1A says that international transaction includes purchase, sale, transfer, lease or use of tangible property, including building, transportation vehicle, machinery, equipment, tools, plant, furniture, commodity or any other article, which means that any other tangible property which you transfer to your associated enterprise gets covered under this clause, other than raw material and finished goods. So you cannot say it's a fixed asset, you cannot say it's not part of the business, you cannot say it's not a business transaction, nothing. Everything needs to be disclosed under clause 11C. Now clause 12 deals with intangible property. So in a nutshell, any transaction involving intangible property, receipt of royalty income, payment of royalty in relation to technology, brand, patents, copyright, customer list, anything that is considered an intangible property will have to be reported under clause 12. Again, there is no exception here. It's quite a exhaustive list and says that or any other business or commercial rights of similar nature. So it is quite wide, and which essentially brings into its net any transaction in relation to intangible property that will have to get reported under clause 12.
Just one clarification here. The definition of intangible property, in the Indian transfer pricing provisions are quite wide. Unlike your OECD transfer pricing guidelines, right? It includes human resource, trained human resource as an intangible. It includes goodwill as intangible. It includes the location savings to an extent also as an intangible. It includes the classic case of expenditure incurred towards advertising, marketing and promotional expenditure as an intangible, right? So if you think about it, when it comes to AMP expenditure, which is abbreviation for advertisement, marketing and promotional expenditure, most of the tribunals and courts have held that it is an international transaction. While how do you determine what quantum of that expenditure is an international transaction, it's still debated, because the bright line test concept is not accepted by the courts. So we got to exercise a little bit of caution when it comes to the advertisement, marketing and promotional expenditure, because if suppose that actually results in being an international transaction, we may have to disclose that as one of the intangible in the clause.
services, which includes receipt as well. Again, any services received. The question, it's quite wide to say that market research, market development, any other services that we may have rendered or received, the payment for it or the receipt for rendition of that services gets disclosed under clause 13. Clause 14 deals with lending or borrowing of money. And this clause is a little interesting because it says lending or borrowing of money including any type of advance, payments, deferred payments, receivable, non-convertible preference shares debentures, or any other debt arising during the course of business as specified in explanation 1c below section 92b2. Now, explanation 92b2 says that international transaction includes capital financing, long-term short-term borrowing, lending or guarantee, purchase or sale of marketable securities, again, payment or deferred payment, receivable or any other debt arising during the course of business. Now the question that comes here is, imagine you are rendering services and there will be obviously a receivable. So do you report it under this clause? Why not?
It is normal, within normal period you don't report it. It is beyond the normal period.
What is normal?
Like what we have given to other people.
What if it's an entity that's rendering services only to associated enterprises? Or there are a lot of entities here that provide services only to associated enterprises.
That scenario we have examined.
Yeah, it's an interesting scenario, and you're right. It's an interesting scenario. In the past, most of the transfer pricing officers were not looking so much into accounts receivables as a international transaction per se, right? But of late, what we are seeing is, the transfer pricing officers saying that any receivable that is beyond the contractual credit period is an advance that you have provided to your group entity, and they are classifying that as a separate transaction itself and imputing interest on the access period that you have provided. So the question is, should we look into those kind of transactions where some of the companies have given a credit period beyond what is contractually agreed, and should those transactions be reported as an advance under this clause? That's something which one has to be careful about in putting together a form or reviewing a form 3C.
And just to
add to that, while the transfer pricing officers have looked at those transactions as an advance, I have not seen an instance so far, that they have levied a penalty saying that you have not disclosed that transaction in the form 3CB. So I hope that continues.
One more same question in the same line. See, if I have received the credit period over and above the normal period, like, can I take the advantages to?
That's a wishful thinking, because while that has been our argument to say that if you are looking at the excess receivable, you might as well look at the excess credit period as well. You can't look at only one side of the transaction. But the tax officers, being tax officers, they have just looked at only the receivables, not adjusting the payables part of it. So, but for disclosure, if it is access credit period given, might as well show that as an international transaction. So at least you have you can place your argument before the TPO saying that while there is excess receivable, there is excess payable as well. So you have to look at the both sides.
No, my question is, to derive the purchase price, can I take advantages and advantages?
Sorry, what derive the?
See, suppose I have imported from my system concern. So to derive the purchase price, as like in international transaction, to derive the purchase price as an arm's length price. So can I take the advantages of excess credit also?
Basically to determine the arm's length, you are saying.
Yeah.
That's what you said. Yeah, absolutely. Because even the law says that you need to do an economic adjustment to determine the arm's length price. And if you have a favorable working capital, that's one of the critical factor to put it before the transfer pricing officers to say that you can't just compare me with others. That's what generally they do. but you should also take these advantages that I am receiving in this transaction and should give enough adjustment for that. That's allowable adjustments in this.
So it was about underlying transaction, purchase or sale. It will take the whatever the advantage or disadvantage of receivables or payable. If it's factored there, whether one more disclosure is required here.
Yeah. So if you are voluntarily saying that that is an international transaction, then that has to be reported under this clause. So whether it is a receivable or payable, whatever the access period is given, that needs to be reported for the disclosure purpose.
So the question is that excess period or reduced period, that component financial impact is already taken into account in arm's length price.
But still that needs to be disclosed for the disclosure purpose in the form. That still needs to be disclosed.
The question that comes then is that the disclosure requirement says that what is the percentage of interest that you charge and so on. So I mean, usually in an intercompany agreement you would specify a credit period, and for example if it's 60 days, if the intercompany agreement specifies an interest rate that needs to be imputed after the expiry of 60 days, okay, you can mention that. If not, then what? Because in all likelihood we are still intending to report it but not levy an interest on the outstanding, right? So then we say it's 0%. Does that open a whole ambit of litigation? We're just offering it to the tax authorities to say that, see, I'm in excess of my credit period but I haven't imputed any interest on that. So that's also a question that we need to bear in mind, and it will be very client specific as well. As you said, if you have something internally where you have transaction with non-AEs as well, then that can be used to analyze whether, if you're operating at par for both AEs and non-AEs, fair enough, we have a basis to say, at least say that, we are not giving an excess credit period to the associated enterprises. Yeah, so transaction in the nature of guarantee. So, I don't know how many of you have seen instances where the Indian entity gives the guarantee, but anyways, all transaction in the nature of guarantee needs to be disclosed here. This is one of the clause where it is interesting to know that you need to give the name and address, the nature of guarantee, in which currency the transaction is taking place, what is the fees that we have charged or we have paid. But they have not said what is the ALP. They have said we need to give the method used for determining the ALP, but what is the value, which is a deviation from all other clauses where they say that ALP determined by the assessee. This is a deviation here. This clause and the next clause does not require reporting the value of arm's length price, even though it requires a reporting of the method which was used by you to compute the arm's length price.
And just to add, actually computation of guarantee price, what should be the ALP, as I see, is slightly difficult because most of the guarantee that you give is to your sister concerns, right? Whereas the guarantee rate that you get in the databases is the bank guarantees that you have obtained. So technically, whether that can be compared, if it can be compared, what kind of adjustment needs to be made, probably by taking into account, the credit rating, the credit worthiness, and those things. That itself is a whole task. I'm not sure why the ALP rate or the arm's length price of that guarantee is not provided in the disclosure, but this is something which needs to be looked at because as I see, it's going to be highly litigated in the coming days. While most of the tribunals, just to give you a background, most of the tribunals have held that corporate guarantee somewhere between 0.5% to 1% as the arm's length. If you ask me, Umesh, what was the basis for arriving at 0.5 to 1%? None of the tribunals have actually done a computation. They just have arbitrarily told that okay, 0.5% either based on the bank guarantee rate or just out of thin air.
Clause 16 is the clause which requires us to report transaction of purchase of or sale of marketable securities, issue of shares and debentures, which involves issue and buyback of equity shares, optionally convertible, partially convertible or compulsory convertible debentures and preference shares, And of course, sale, issue and purchase and sale of marketable securities. So, where does purchase and sale of non-marketable security get disclosed is another question that we need to deal with. Now, if you notice this, this is one of the clause yet again which does not require reporting of the arm's length price. It just requires a method in which we have determined the arm's length price. Now, another thing that is interesting is the issue of shares, and you all must be aware of the controversy that surrounded issue of shares and whether it is an international transaction and so long and so forth. And while it's a corporate action, right? Issue of shares is a corporate action, so a view may be taken that it is not an international transaction. The Form 3CB still requires a disclosure, so does the Act. The Act also envisages a situation where issue of shares is an international transaction. I mean, litigation has gone around and we have almost reached a conclusion that we can consider it not to be an international transaction. The form requires it to be disclosed. Now, even though the amount does not require to be reported, the method of determining ALP needs to be reported. Then the question comes as to how do you determine ALP for issue of international transaction? It's a corporate action. It is so interlinked into the business of the SSE, the facts, the fund requirement, and so on. So how do you determine that? And you should have something.
Yeah. Just one point I just want to add. Maybe you want to just. So just one point that I want to add. Issue of equity share is common transaction that most of us come across, especially when the company is starting up, and even subsequently when the company needs certain funds. While it's debatable whether issue of equity share is an international transaction or not, because it has no bearing on the income per se, and that's the crux of transfer pricing. The institute guidance says that since the government of India has not gone ahead with the Vodafone litigation, where there was an issue of shares with the premium, and the tax officers contended that that itself is an international transaction, and by charging a premium, you have indirectly funded the overseas company. You basically treated that as a loan transaction. So since the government of India has not contended that, a call may be taken that it's not an international transaction, and also given the fact that it has no bearing on the income per se. So that's the institute guidance note on that issue.
See, when you issue it shares at the first time, whether it should be reported.
Yeah, so that's what we do, and what's our view is. When you issue the share, obviously at the time of issuance you are not related parties. But the way the Act is worded is that at any time during the year, if you are associated enterprises, then you have to report that transaction. If issuance of share is the only transaction, as it's not an international transaction per se, because it has no bearing on the income, probably a call may be taken that we don't have to report that transaction. But if there are other transactions along with those transactions, what we think is might as well just report that transaction along with other transactions, so that there is a complete disclosure of the transactions altogether. But after Vodafone, at least I have not seen any instances except that Shelley case, I guess, yeah, where the transfer pricing officers have started have questioned the issuance of shares. So that's our experience.
So, as Umesh said, issue of shares, it is a contentious issue here, and we need to take the appropriate call. Now, another question that comes up is, we may take a call that it is not an international transaction, but we'll still report it because the CbCR and the Act still emphasizes it to be an international transaction. So, in calculating the aggregate value of international transaction, do you include it or not? I mean, it can go either way, but I would think that if you are reporting it in the main clause, you might as well just include it. But again, it is self-contradictory in the sense that while you are reporting, you are also calling it out to be not an international transaction. So, to that extent, the form does not give you any leeway. Clause 17 deals with transactions by way of any mutual agreement or arrangement. Again, here the disclosure requirement is fairly standard. We have to give the particulars of the agreement or arrangement that is existing between the assessee and the associated enterprise, and the name and address, the amount as per books of account, as well as the value amount determined to be at ALP, and the method that we have followed in determining the same. Clause 18, transactions arising out of business restructuring or reorganization. So what is business restructuring and reorganization in itself is it's a contentious issue. This slum sale restructuring, change in shareholders, reorganization. So it fairly can cover everything, but the revised ICA guidance note says that it means an arrangement, restructuring of function, assets or risk, which means that something that has resulted in the FAR that we have done undergoing a change, or termination or substantial renegotiation of an existing agreement, which means that an ongoing agreement being revamped or terminated and entering into new transaction or new anything that is resulting in a substantial change in the FAR. Or organizational change, that is an ownership structure, management of the entity. All of this gets covered under restructuring and reorganization. Now another thing about restructuring and reorganization is that these transactions needs to be reported regardless of whether it has an impact on profit, income, asset or losses in the current year or in any of the years. Like for example, if the current year it does not have an impact on the profit, income, asset or loss, but in the future it still needs to be reported. It is one of the clause where it says that it needs to be reported even if it has nil impact. Basically, I think it is a way for the tax authorities to pick out that there has been a restructuring or reorganization that needs to be looked at or scrutinized. Clause 19 is a residual clause which encompasses everything. Like basically, any transaction having a bearing on profit, income, loss or assets needs to be reported in clause 19. It can be reimbursement, recovery, it can be anything. Basically, it can also be something as simple as ESOP. I mean, we have not reported it anywhere. It's not a service. It will get coming here. Now, this being a residual clause, everything and anything that didn't get covered in or was listed earlier gets reported here. The question that I have for all of you is, what about free of cost assets or services? Like if a company or your client has got free of cost asset, which is technically not reported in the books of account, then do we need to report it? It's still a transaction, right? And it says, I mean, we can always take a view that it does not have an impact on the profit, income, loss or asset, but if it was an asset and had we recorded it, it would have had an impact. So any thoughts on that?
How does this different from the intangible assets we were talking just before?
Okay, so when intangible asset, essentially there is a list that we are talking about. Anything in relation to technology, royalty, customer list, etc. qualifies as intangible asset. Here I am not talking about an intangible asset. For example, sometimes imagine a software development company. They might have to do testing as part of the development process. So what happens is that the AEs will send across the equipment to assist them in the testing process. AEs send it across because it is required for the testing process. So the assessee does not record it in the books of accounts. So I am talking about such assets which was being given by virtue of a requirement because we are rendering services, but it is not recorded in the books of accounts. So then what happens? Should that be recorded in the Form 3CB? It's a very much tangible asset. Should it be recorded in the Form 3CB? Should it not be recorded in the Form 1?
In practical scenario, even if we get any free of cost certificate, at least transportation cost also will be added. We will book it at least at the transportation cost. So ideally it will be recorded in my books. At least at the maybe not the correct value, but at the lesser value. So,
Okay. Okay.
so the practical scenario is not completely not recorded. May not be there.
Okay. 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 Fair enough. So what you are saying is that you will record the value that you have recorded the books of accounts. Then what will be there? You will record the actual value. You will have to do a valuation.
Yeah.
Okay. What about services then? For example, a US company assistant HR or recruitment or accounting, like the group is centrally helped, and in usual cases they cross charge their cost, or in case we are rendering a service free of cost, should we report that? And how do you find out about that?
Not quite easy.
It's not why.
It's not a transaction.
Because there is no remuneration. So isn't that the crux of transfer pricing? That imagine I sitting in India, help a US entity, which is my group entity, hire somebody, which is essentially means we are rendering services, but we have not cross-charged that cost or have gotten remunerated for that service. That's essentially the intent of transfer pricing, right? We do something and we don't get paid for it. That is what transfer pricing exists for. So then, why would you not do it?
No, you're talking about receiving.
Oh, okay, receiving, I understand. So you're saying if it is a receipt, you won't have to report it. So if it's a receipt, you have to report it, right? Or receiving of services.
A receiving of service, if it's income for the entity, I think it's not. I'm sorry, it's other way. If it's income, it has to be reported.
It has to be reported. And you will report it under clause 13 or clause 19? It will be 13 there.
Yeah, see, what the institute guidance says is the free of cost asset. While technically what happens is you don't report that, you don't capitalize that because you have not paid for that, right? Asset, you have just got it for free. So that you don't capitalize. But if you think about it, it's quite debatable issue that way. Assume a company which is operating on a cost plus model, right? What happens? If you have paid for an asset, the depreciation you consider in the cost base for charging a markup. Whereas if it is a free of cost asset, actually there is no charge of depreciation in the cost base for that markup. So technically if you look at it, by not charging markup on that cost, which should have been charged, actually your cost base has shrunk. To an extent, there is a base erosion that has happened, and the profit that is chargeable to tax probably in India has got reduced. So far not questioned, these transactions were not questioned by the transfer pricing officers, but what we are seeing in the advanced pricing agreements is that, especially these kind of transactions, they are saying that even if you have not paid, the value of that transaction you should consider in the cost base, maybe a part of depreciation of that for the markup purpose. So that's what we are seeing in the APA scenario. Of course, we have not seen that happening in the transfer pricing officers case so far. But there will always be information passing between the authorities possibly, and I'll not be surprised if one day they will say that okay, you should have disclosed this transaction and you should have also considered this transaction in the cost base. Now that's on the disclosure part of it. But on the arm's length part of it, if you just think about it, it's not very uncommon between two third parties to actually enter into an arrangement where I will say that look, you perform this service, I will give you this material, but you will charge your whatever markup or anything only on the cost that you have incurred and not on the material that I have provided to you. It's not very uncommon, but that's the later stage of defending the transaction. As far as the first stage of disclosure is concerned, the institute guidance says that all the FOC related, the free of cost asset related transaction needs to be reported under clause 19 for the completeness sake. So this transaction, I guess, is going to be a debatable issue in the future. The FOCs, the bank guarantees, royalties.
Excuse me. Cost plus model is a very big cost to be included. In the sense,
company is 100% rendering service to the foreign entity, wherein they are paying all the service for whatever the services they are rendering, they are paying advance. That means end of the year, if you look at, like there would have been some advance lying in the Indian entity books. So should it be considered if the company had not received that advance, they would have borrowed that money, and hence they would have incurred some the cost of the finance cost, right? Should that be deemed as a cost to include to arrive at the cost plus the cost plus product?
Yeah. So the question of advances actually, see, there are two aspects to it. One is disclosure of that transaction, the advances. Second is how do you defend that transaction as at arm's length, right? The transaction of, say, provision of services. The disclosure of transaction, obviously the advances you will anyway show in the form 3C. Now comes the transfer pricing documentation part of it, where you have rendered the service, say at cost plus 10. You have to say that the cost plus 10 is at arm's length. Now what do you do? In a normal scenario, you select a set of comparables, and those comparables may be, for the hypothetically, say at cost plus 12%. Okay, the markup on the cost of those companies were 12%. Now, I think this is something which we were discussing a while ago, saying that in comparing those two rates, like 10 and 12, you invariably have to do that economic adjustment, which is generally called a working capital adjustment, to say, which is nothing but saying that since I have received the money in advance, there is an interest saving to me from those transactions, and that transaction, the value has to be adjusted in the 12%, right? So what happens generally is that 12% will reduce to say 9% or so because of the advances that you have received, and compared to those comparables. Then in the documentation you can say that my transaction is at arm's length and the adjusted price is what I have looked at. So economic adjustment invariably is something which one has to consider when it comes to transfer pricing documentation and demonstrating that the transactions are at arm's length. So it goes without saying.
So another question that I have is I go back to the receivables. So in case we take a stand that it is not an international transaction that requires disclosure of that clause, do we still disclose it here? I mean, there's a requirement to disclose the percentage and all of that. But the Act does not say this is the normal course. It does not say over and above what is in the normal course of business. It does not say over and above what is stipulated in the intercompany agreement. So does that mean we don't have to disclose it at all, or do we disclose it in clause 19? I mean, what is your experience? And if we do disclose it, do we consider it as an international transaction for calculating the aggregate value of international transaction? So our opinion is that ideally we would not disclose it in the other clause. We will disclose it here for abundant caution, so that the form is complete, and since we are responsible for giving complete information, we will disclose it, and we will just not include that in the value of international transaction. So from a disclosure perspective, we are safe, but we are clearly carving it out to say that it is not an international. Deemed international transactions. Deemed international transaction refers to a concept where an Indian entity has a transaction with a third party, either resident or non-resident. The terms of those transactions have been influenced by the associated enterprise. So it's first of all, the question is, how do you identify that sort of a transaction? Most of us would start with an audited financial statement, look at the related party schedule, and then go. This is completely unrelated. How do you start with this? You will have to start with asking the client about, is there any transaction that is a global arrangement, where agreement is entered globally, so on and so forth. Now what if the agreement is entered globally? Most of the times what we see is that in this global phenomenon, there will always be a master service agreement globally, which is backed by a local agreement here. So does that mean that the terms of the transactions are agreed globally, or does that mean it's agreed locally? I mean, it is subjective, but the thing is, we need to look at each case individually and subjectively and say, is there any negotiation done by the Indian entity? Does the Indian entity have any leeway to not enter into this contract? Is there I mean, the global agreement might have been for economies of scale. So in there it might be possible that Indian entity is benefiting by just agreeing to that. But then do we report it, do we not report it? If we can tangibly demonstrate that there has been some involvement of the Indian entity in agreeing the price, negotiating the price, the terms are independent of the global entity, then we can take a call not to report it. But then again, there should be, as I said, tangible evidence. There should be a proper trail to evidence it. If it is a mirror of the Master Services Agreement in India, then how do we demonstrate that the Indian entity has consciously taken a decision to enter into that contract? So this is one clause where a lot of attention needs to go, and a clause where it is not easy to pick out this transaction from the face of a financial statement. This requires deliberation and constantly engaging with the client, making them understand, because at the end of the day it's only a client that can say that we have a transaction like this. So it requires educating the client about the requirement so that we have the information that is required. Like one example that I can give is sourcing of laptops. In a global scenario, sometimes what happens is that they globally enter into an agreement with a Dell or HP to source laptops for all its affiliates. And then laptops are supplied. In some countries, the laptops might have been supplied at a rate lower than what is prevailing in their market, and in some countries it may not be. But as a group, they benefit. Similarly, Windows OS. So those are things which we see commonly getting covered under this deemed international transaction clause.
So what we have seen is, as Ruby was also mentioning, that this one transaction is very difficult to really get it, right? Because most of the time what happens is your first starting point when it comes to international transaction is the related party disclosure. Straightforward, right? Or you will look at the ledger, you will look at the holding structure of the company, look at the ledger, and then you can figure out that okay, these are the international transactions that needs to be reported. Deemed international transactions. The beauty of this transaction is that these transactions are entered locally in sometimes with a third party. So nowhere it's shown that okay, this is a transaction which had a master agreements elsewhere, and because of those master agreements we have entered into this transaction. Very difficult to identify. Maybe questions with the taxpayer, like you have these transactions, and whether any of these transactions are pursuant to a master agreement that your parent would have entered into with that third party globally. So I think more of probing is required, especially in these transactions, to unearth these transactions and showcasing these transactions. So far, very less number of cases, as I see, would have got scrutinized by the transfer pricing officers, which are deemed international transaction, because most of the cases, unless you disclose, probably nobody will come to know that okay, there are these transactions, right? And the moment you disclose, then only the things start. But the moment you disclose, obviously then there will be questions on how these transactions are entered into, what are those transactions. And there comes the difficulty of getting the master agreement relevant to those transactions, because most of the time you will have only SLAs or whatever what we call as a local agreement with the third parties, but you hardly have access to a master agreement which would have entered into globally. So sourcing of those documents, having a look at those documents, which will be will be an evidence or will be a document necessary to conclude that these transactions are at arm's length. I think these are the challenges we see, and probably these are the things that we have to ask the client during our the review of Form 3C.
In your experience, have you reported any transactions?
Oh yes, we have reported certain transactions because what had happened is it was not that harmful in the past. Because earlier the laws said that if you have a transaction with a third party, then it will be an deemed international transaction. The law slightly got changed to say that the third party, whether he is resident in India or outside India, it doesn't matter. So you have to report that transaction. And most of our clients or the cases, the third party will be in India. So earlier you could have ignored those transactions, saying that okay, it's not an international transaction, it's a domestic transaction at the end of the day. But because of this change in law, I guess in FY 14-15, you end up actually looking at these transactions and reporting those transactions as well. But defending those transactions is, I would not say always, but most of the cases is easy, at least in Bangalore I would say, because most of the companies here operate on a cost plus basis, and whatever cost you would have incurred with the third party, you would have considered that in your cost base for markup purpose. And more often than not, you actually look at the net profit in determining arm's length price, which already factors in this third party cost. So defending, not in always all the cases, I again say, most of the cases at least it's still defended, but disclosure is becoming mandatory. And we did report the transactions.
Yeah, and just adding on to that, the question that comes up is should it be a tripartite transaction that needs to be reported, or is it a four-party transaction that needs to be reported on?
Just one point there. So one point there, the difficulty that we find is who do you report as an associated enterprise? Whether your group entity's name will come in the Form 3CB or the name of the third party will come in the Form 3CB. So theoretically and technically also, you have to report the third party's name as a associated enterprise. Not many of the third parties will be willing to disclose that transaction, right? And just think about it. While you might not have reported the third party's name as an associated enterprise, the transfer pricing officer will have access to all the Form 3CBs. The third party would have reported your name as an associated enterprise when they filed the Form 3CB. So that's how they will come to know that, okay, there are these transactions which you have not reported, but they have reported, and you have not, to that extent, fully disclosed the transactions in your Form 3CB. So there is a high chances of, getting exposed that way. And one may have to have a dialogue with the third party as well when these kind of transactions are entered into, as far as reporting is concerned.
Would it happen in domestic transaction?
It could be overseas as well, right? Huh?
Cross information may not be available.
Yes, it's more likely to happen only if it is a domestic transaction, unless the overseas entity had to file a Form 3CB in India for various reasons.
So as I said, deemed international transaction requires higher scrutiny, and especially given the fact that there is master file and all that is also going to get filed by the entity, and master file essentially just captures the whole global phenomenon along with agreements and arrangements and everything. So greater onus on us to identify such transactions and engage in a dialogue. So we move on to specified domestic transaction, and I'll be very quick because we need to take the CbCR master file with. Before I go on to specified domestic transaction, how many of us here have Form 3CBs that have specified domestic transaction reporting? Because we have very few. We have very few. Thank you. So as you are aware, the first and foremost is that the specified domestic transaction clause gets triggered only once the 20 crore threshold is reached. So if you do not reach the threshold, even if you satisfy the criteria, no reporting is required. Again, the reporting requirement is similar. Name, address, PAN of the nature of relationship, just like the clause 10 of international transaction, except that the PAN of the also needs to be reported. Brief description of the business. Clause 22, 40A2B, transaction of any expenditure in which payment has been made to a person referred to in clause, section 48(2)(b). Now the interesting fact is that this section no longer exists, in the sense that 48(2)(b) exists. This is no longer covered under specified domestic transaction. However, the form still has this clause. Do we have to report it? I would think no, because the form just has not been amended to encapsulate a striking of the term. Clause 23, 24 and 25. 23 and 24 are in relation to tax holiday eligible businesses as well as eligible businesses to which section 80IA 10 and 10A are required. Any 23A refers to transfer of any goods and 23B refers to acquisition of any goods. As I said, that the reporting requirement here doesn't vary significantly. It is just the name and details of the entity or the unit with which you have had transaction, description, amount, both as per books of accounts, as per ALP, and the method that you have used to compute the ALP. So section 25 says any other SDT not specifically covered in other clause. Now, I mean, we can speculate here. The thing is, international transactions has a threshold of 26% and SDT has a threshold of 20%. So the differential, does it get covered? In the sense, 42B I know is rescinded, but still anything about 20%, but in between this, does this get covered? I would think not, but just putting it out for your thought. So I think we have discussed this while discussing the Form 3CV. We need to identify the transactions, map the transaction, document the current policy as well as any allocation or pricing. We need to benchmark these transactions. And as I said, it is very important that we have a benchmarking and a supporting analysis in place before we file it, because methodology, value, any adjustment that needs to be done in the return of income. All of that is, so essentially Form 3CP and DP documentation go hand in hand. It is inexplicably linked. And compliance requirement and impact assessment, basically to identify transaction, FAR and all of that. I think we discussed that while we were discussing the Form 3CP. I'll just take you through the penalty, legal consequences, and then hand it over to Umesh. So failure to maintain transfer pricing documentation under section 92D read with rule 10B, or failure to report a transaction or maintain or furnish document under section 271AA, the penalty is 2% of the transaction value. Failure to furnish accountant's report, the penalty is 1 lakh. Concealing particulars of income or furnishing inaccurate particulars income, adjustment to taxpayer's income during the assessment proceedings, 100 to 300% of the tax ought to be evaded. Honestly, we still haven't seen a situation where this penalty has been invoked, but if it does get invoked, I would think that it's quite substantial. Essentially, if we are in a position to establish that we did not furnish inaccurate particulars, that whatever we furnish as a transfer pricing documentation or support things for bona fide and good belief, I think we still have a leeway around this section. Failure to furnish information during the assessment proceedings is again 2% of the transaction value. And the master file requirement, if you do not file the master file then, or furnish information required in the master file, then it is 5 lakh rupees of penalty.
Just on that 271(1)(c, that seems a little scary there. 100 to 200, 300% of tax. So it's an interesting thing where it says that if the TPO had made an adjustment to the transfer pricing that you have disclosed, transfer price that you have disclosed, then it's given that that amount is something which is a concealment of income. But also it then says that if, however, you have submitted the documentation during the audit proceedings, you have submitted all the information that the TPO has asked for during the audit proceedings and all, then to an extent there will be a relaxation or application of that 100 to 300% of the penalty. So while it in the first instance it says that concealment straight away furnishing of concealment of income if there is any adjustment, but then it mellows down to say that okay, if you have submitted all the information document including the TP documentation and the audit proceedings of the case, then to an extent you can say that I have submitted everything, it's just a difference of opinion at the end of the day between me and the transfer pricing officer, and therefore there should not be any levy of penalty. And in most of the cases at least we have seen, as far as penalty is concerned, we have seen the tax officers have been
So I will just hand it over to Umesh to take us through the CbCR and master file provisions.
Before that, if you have any questions on the Form 3CB.
Supply from domestic tariff to SEZ, should it be reported under domestic transport?
Domestic to?
No, from domestic. Like I have a 2 unit, one in SEZ, one in normal domestic. From transfer manufacturing domestic transfer DPA and transfer to the SEZ. It will be covered.
So basically, DTA, domestic tariff area to SEZ, transfer of goods.
DTA to SEZ.
I think we have to first see what clause it will come under, under 80.
SEZ will claim exemption under 10A.
So then it will be clause 23. It will be under clause 23. But you are saying that it is between?
Between one unit to another unit. One unit is located in SEZ, another unit located in domestic tariff area.
So it will get covered under clause 23.
So those how will be reported because both are same time.
Yeah.
That is okay.
Go ahead.
Yeah, so basically in the clause 23 you don't need to report the PAN, you just need to report the entity name which will be our own entity with a hyphen saying this is the subunit of the entity. In the clause 22, when you report the name of, not 22, 21, here we'll have to give the PAN of the E. Essentially that means that we'll have to give our own PAN basically because we are transacting with, it's one hand to the other hand. So we'll have to report it under clause 21 with the PAN. Clause 23 we'll report it but give the name of our own name with a hyphen as to which unit is it. I mean, there will be some manufacturing or SEZ or something of that sort to just clarify what we are on.
So in the case of receivable, previous year reported as reportable transaction, but current year it has become doubtful because of associated enterprise actually became bankrupt. So how we can report? How we can disclose in the receivable?
So, see, the call we take is, if you are passing an entry which is affecting the related party, then you need to report that in the form 3CB. If it is a unilateral action, for example, if you just say that, okay, this probably is not possible to be recoverable, and you provide for that and things like that, we say that, okay, probably you don't have to disclose those transactions.
It's a provision for doubtful.
So as long as if you are giving the effect to the related party there, you may have to still disclose that for the complete list.
So we also did have a similar situation that he's talking about where same thing, basically a unilateral action was taken by the Indian entity to say that this is a doubtful debt. It was reported as a transaction in the prior year. We still went ahead and reported it because it essentially impacts the associated enterprise. So it was reported. Any other questions?
Company did not issue any shares during the year, but it has issued the previous year to the like a person outside India. Still, the form will be filing this year.
Ideally, it should have been reported.
That year we have reported that.
Then this year is not required to be reported.
Current year nothing is reported.
Okay.
There is no other transaction.
Okay, thank you everybody. Umesh, and just take us through the CbCR and master file requirement.
Thanks, Rudy. Well, few things on.
Sorry.
But
Can we change the method between the last year to current year?
you certainly can change the method compared to last year to this year. The challenges, I'll tell you what we have seen by changing the method. Your transfer pricing 3CP will be filed, but the transfer pricing officer who has access to the last year file as well. If there is no change in the facts, the question will come, why did you change the method? So you first have to justify the approach that you have followed this year, which is different from the last year, in the transfer pricing documentation. As long as you can do that, I don't see any challenge in changing the method. The one classic case is if you have applied comparable uncontrolled price method, this year there are no comparable transactions, so you might as well look at other methods, maybe TNMM or some other method to justify the compliance. So few things on transfer pricing compliance. While Form 3CB is one aspect of compliance, right? And the underlying documentation for that preparation of Form 3CB is also equally important. One is Form 3CB, the chartered accountant has to certify, and the institute guidance says that the chartered accountant who is certifying that need not really comment upon whether the method used for that transaction is at arm's length or not. Right? Whether it's the most appropriate method or not, he's not required to really comment upon that. All that he has to comment upon is whether that is the method actually used to justify the arm's length nature of the transaction in the documentation. So if you look at it, Form 3CB is one aspect of the compliance, but more important is the transfer pricing documentation as well, because in Form 3CB most of the numbers either flowing from the financial statements and all. But analysis is also equally important. What the law says is it gives you a threshold of 1 crore value as the value of international transaction. If the value of international transactions are beyond 1 crore, then one has to maintain a very detailed transfer pricing documentation. In the beginning of the slide, the discussion on Form 3CB, we just touched upon these points. You have to maintain details of the background of the group, the details of the Indian entity, the functions, assets, and the risk analysis, and the economic analysis, and also we have to document the industry to which this transaction pertains to, or that entity pertains to. So these things one has to document in the TP documentation if the value of international transaction is beyond 1 crore. So the law says that if suppose it's less than 1 crore, then you don't really have to maintain a full set of documentation. You can still file the Form 3CB without having the documentation, but the onus is on the taxpayer to demonstrate that the transfer price which he has applied for that transaction is at arm's length. While there may not be a full set of documentation, he may still have to say have the comparable invoices which were issued to the third parties. He might have followed a comparable uncontrolled price method to demonstrate those transactions. So he has to have some level of documentation which may not be as structured as a TP documentation to be maintained to demonstrate that the transactions are at arm's length. So that's one interesting thing about the transfer pricing compliance, especially on the TP documentation part of it. The second important aspect of documentation is what is this functions, assets, and risk analysis. So some of you might have have had an experience with the preparation of transfer pricing documentation in the past. So how have you gone about the analysis of functions, assets, and risks? Any thoughts around it? You would have seen that most of the tribunals and everyone is saying that the transactions are comparable only if the functions, assets, and risks are comparable, and things like that. But what are these functions and assets and risks? Let me just try to explain that in a very layman term. If you give a job to a particular person, how do you negotiate a price with him? How do you determine what should be the price I should pay to him? You basically see what kind of activity he is going to do, right? And you basically see what level of risk he is going to bear. When I say risk, whether he is directly going to enter into contract with a third party, and if suppose that contract do not go through, then the contractual failure, that risk is on him or on you. So you will first see what kind of activity he is going to perform, what kind of say intangible property or the asset that he is going to bring in to perform those activities, and what kind of risk he is going to bear, right? Let's take an example of you construct a house, right? Let's assume a case where you get a material for the construction of the house, and you provide all the materials, assets, and land and everything. All that the other person has to do is bring in labor and construct the house, right? That's one type of activity, one kind of arrangement. The second type of arrangement is you find a contractor. You tell him that, look, I have this money. It's your responsibility to arrange for the labor, arrange for the material, arrange for all the regulatory aspect of it, of constructing a house, go to the municipal, get the permissions and everything. Eventually, you give the time frame saying that in 1 year's time I want to see a structure on this land and this is what I want to see. Will you pay the same price that you would have otherwise paid to a guy who is just giving you a labor to a contractor? The price that probably you pay to a contractor is much higher than the price you pay to a labor, right? I'm trying to be as simple and as coherent as possible as far as this FAR analysis is concerned. That's what the FAR analysis is. So when you look at the FAR analysis from that perspective, all that you see is this is the arrangement, what I am going to do, what the other person is going to do, what his activities are, what kind of skill sets he is going to bring in, and what kind of risk he is going to bear vis-a-vis what kind of risk that I am going to bear and I am going to perform. So this is very, very crucial in transfer pricing because most of the time, as we saw in this example, the price is dependent on who performs what at the end of the day, and that's what the transfer price is, right? The exchange price at the end of the day. Now let's come to how it has evolved over the period of time and why we are talking about master file and BEPS and the CbCR requirement. When we started, and India is an inbound country at the end of the day. What you get is you get people coming in, the work will come into India and you probably perform a part of the work which will go and fit into the larger scheme of things at the group level, and then if it is a product, it will be sold to a customer there, or if it is for an in-house use, it will be used by the group in-house. And in the transfer pricing documentation, what you document more often than not is only one side of the transaction, what India performs. Hardly you would have, or we would have, for that matter, disclosed what the overseas entity performs. Okay, so if you look at it, in a way, you are looking at an elephant, and probably you have drawn only the tail of the elephant in the transfer pricing documentation, whereas there is a whole body of the elephant which is missing in the documentation. Now, to really appreciate a transfer price and to really do a arm's length analysis, one has to look at the whole elephant. Now, that's the exercise which this BEPS, which is base erosion and profit shifting action points by OECD, try to do. Transfer price, if I have to tell, was the most controversial matter across the world. Primarily because there is not much of information that get exchanged between the parties, and each in the transfer pricing documentation just demonstrate only one part of the transaction, not the whole picture. So what BEPS tried to do is few things. One, or rather three things. They first tried to rewrite the whole transfer pricing guidelines to an extent. Right? They tried to explain, what is function, assets and risk analysis, how should you go about it. Second thing they tried to do is, they tried to build in a consensus amongst the countries, and so that there is a sharing of information that happens between the countries. Third thing they tried to do is, they tried to bring in a lot of transparency in the process, so that the taxpayer will give more information in terms of reports to the tax officers, and even the tax officers will have access to the information which the group entity has filed in the overseas. So this is what the BEPS action points tried to do, and one of the action point in the BEPS was action 13, which essentially talked about the requirement to prepare a master file and the CbCR. India was observer for the OECD's this action, and India also, as you would have noticed, in Finance Act 2016 came out with the BEPS related requirements. They incorporated that in the Indian regulation, which is nothing but the master file and the CbCR. Now, once it was introduced, effective 15, that's effective for 15-16, first year will be 16-17 financial year. What we saw was, there was a lot of confusion. People were like, when it has to be filed, what has to be filed, things like that. Then there were a lot of amendments and a lot of clarification that was provided by the government in terms of the due date for filing of the master file and the CbCR, and at least now I would say that there is a bit of certainty on what has to be filed by when, right? Alright, now country by country report. Let's first touch upon this and then we can briefly touch upon the master file requirement. As I said, the whole requirement of disclosure is summarized or detailed in the action 13, which talked about 3-tier documentation. What is this 3-tier documentation? The action point says that you have to maintain a master file, you have to maintain a local file, and you have to maintain a country by country report. The master file is a qualitative aspects of the whole multinational group. It talks about what the multinational group is into. It talks about what are the primary functions of the multinational group, what are the intangibles owned by the multinational group, what kind of financial arrangement that they have, and then eventually do they have any kind of advance pricing agreement for any of those transactions in any country. CbCR in particular is more of a quantitative aspect of the multinational group. When I say the quantitative aspect, it essentially talks about each entity wise and each jurisdiction wise. It will give a breakup of the revenue of the multinational group, the taxes paid by the multinational group, the number of employees of the multinational group in each jurisdiction, and what is the profit earned by that multinational group in each jurisdiction. And then it further goes to talk about what kind of activity is performed in each jurisdiction. Okay, now we'll get into the specifics and how does that play out in a while. But first, the applicability of the CbCR report. Now, the Indian law says that the CbCR is applicable if the group turnover is beyond 750 million euros in a year preceding to the previous year. Now, 750 million euros roughly turns out to be about 5,500 crores. Now that the exchange rate has gone up, probably it will be maybe more higher, but I guess that's the exchange rate one has to consider as on the end of the financial year of that year, and do the math and to determine whether there is a CbCR requirement or not. If a group, it's a consolidated revenue, it's a group revenue. If the total group revenue, for a simplistic say, if I take 5,500 crore, if it is in excess of that or it's hitting the 5,500 crore, then the group has to prepare the CbCR requirement. Who has to file that CbCR requirement? Now, the first onus is on the ultimate parent entity to file the CbCR in its jurisdiction. Okay. Now, let's take an example. Of course, India has not yet entered into a multilateral agreement with US to share the CbCR, but for the example's sake, let's take the case that US has prepared a CbCR document. Now, that CbCR document that has been prepared by US, it will file with the IRS there. Now, what the Indian entity has to do, which is part of that group, is to just file a notification in India saying that my group entity in the US has filed the CbCR. That form is called Form 3CAC. And if you do that, your obligation is through. Okay, and that filing has to be done 2 months prior to the filing date. Before that. So India says that you have to make that notification 2 months prior to the end of 12 months from the end of the accounting period followed by the US. For example, if they had followed, say, Jan to December financial year, and December 2017 is the closure of the financial, 12 months from there is December 2018, and India has to file a notification in India with the authorities saying that my group entity, ultimate parent entity in US is going to file the CbCR. That notification has to be done 2 months prior to December, which is October 31st. November and December, yeah. So that's the notification India has to do. What will happen after that? So Indian authorities, of course, as I said in the beginning, India has not yet entered into a multilateral arrangement with US for exchange of information. India will automatically get that CbCR from the US, the Indian authorities. Okay, we'll get into what is the use of that document for India. if, for example, for whatever reason, the US parent has not filed the CbCR, or India has not entered into an exchange arrangement with US, and it has not shared the CbCR requirement with the US IRS there, then the onus will fall on the Indian entity to file the CbCR document in India. Right? Now, everybody in the first year, that is 16-17, were a little worried, because at that point in time, India had not entered, even now, India had not entered into a multilateral arrangement with US for sharing of information. So everybody was a little worried whether then the Indian authorities will insist that the Indian taxpayer has to file the CbCR in India. And it's a huge set of information which probably the Indian entity will not be able to gather, and because we are not consolidating the financial, right? It's getting consolidated at the US level. Probably they will have a lot of information related to that. So, but luckily the government, sent a clarification saying that in those cases, Indian entity need not file the CbCR. We will let you know when it has to be filed. So, as of now, there is a bit of relaxation as far as that clause is concerned. It says that even in the cases where either there is no filing of the CbCR by the overseas entity, or there is no exchange agreement, the onus will still not be on India, and India can the CBDT will come out with more clarification on that. The second way of filing the CbCR is the parent entity can nominate another entity in the within the group to file the CbCR. It is called surrogate filing, or alternate reporting entity filing. So, for example, India has an entity in UK, and UK has a treaty with India for exchange of CbCR. And so the US entity can say that, okay, I will not file that, but the UK entity will file the CbCR in its jurisdiction, which will anyway be shared with all the other countries which had a multilateral arrangement with the UK. So that is also possible to do. But in all these cases, if there is such arrangement, all that Indian entity has to do is file a notification with the authorities. Now, a question may come on if there are many entities in India, who will, is there any scope or room to say that only one entity will file the CbCR in India, or the notification in India, right? So there are, like, say 3 or 4 entities in India, the subsidiaries, I would say. The law says that yes, you can file a notification, but unfortunately each one of them have to file a notification individually to the authority, saying that I will not be filing, but my group entity will be filing, which is slightly different approach from master file, I would say. So the threshold we just talked about, the applicability, manner of submission. If for whatever reason India had to file the CbCR, which will happen if, suppose, say there is an Indian headquartered company, and that company's turnover exceeds 5,500 crore, consolidated group turnover, then the onus will be on the Indian entity, the ultimate parent entity, to file the CbCR in India, and that form will be Form 3CE80, right? This is the content, we just talked about it. All that you have to disclose is the revenue, which will be each entity wise, and the geography wise you have to disclose those transactions. Profit and loss, income taxes paid on a cash basis, income tax accrued, capital, accumulated earnings, number of employees, tangible assets other than cash and cash equivalents. And just to clarify, the definition of constituent entity also includes permanent establishment. So if suppose there is a permanent establishment in one geography, then they also have to be part of this Form 3CEP, and they have to be reported as a separate entity per se, and disclose those transactions. So as far as the information like stated capital and the various, I think the stated capital is concerned, the OECD guidelines, this clarifies that you can mention the capital of the entity of which you are a PE in the CbCR document. So in the part B, you have to disclose tax jurisdiction of organization, or basically the tax jurisdiction, the main business activity of each of the entity, and there is a list of business activity provided in the form, which is research and development, holding or managing intellectual property, purchasing or procurement, manufacturing, sales. So there is a whole list of document, the activities provided. So this information has to be populated in the CbCR. We just touched upon these aspects, like who has to file the CbCR, whether it's the parent, and what is the onus. If the parent is filing, then what's the onus on the Indian entity to file? Whether just a notification is sufficient, and what are the instances where the Indian entity also has to file the CbCR. So those things are detailed here. So far, there are 104 countries signed for exchange of information, and this is a list of information, a list of those countries. Very soon, I guess, India will have an arrangement with US as well. What we understand is the discussion is ongoing for that arrangement. These are the various forms. 3CAAC, as I just mentioned a while ago, it's a notification form where if you are a part of the multinational group, if you are an Indian subsidiary of a multinational group, you basically say that the overseas entity is going to file the CbCR. Filing of CbCR, which is in form 3CAD, either an Indian headquartered entity will file that, or Indian entity of a foreign group which is designated as an alternate reporting entity will file that. Or in certain circumstances which we just talked about, the onus will be on the Indian entity to file as well, especially in the cases where there is no exchange of information agreement, and or the overseas entity, the jurisdiction of the overseas entity may not have the CbCR legislation itself, things like that. And this is for 3CEAE is a form which you file where there are multiple entities in India, and any one of them can file a CbCR. Sure. Now we'll touch upon master file, and then we will see how these information are going to unfold when it comes to transfer pricing, because this seems to be a new development in transfer pricing, right, compared to what we have seen so far in the past. As I said, master file is essentially talks about the qualitative aspect of the business group. What we so far saw in the CbCR is more of a quantitative. It all deals with the numbers. Here it all deals with the qualitative aspect, or what kind of business it is into, right, and what kind of functions they perform, what kind of intangibles they have. So to whom it is applicable, master file. So the master file again is split into two parts, part A and part B. Let me just skip to the next slide so that the part A and part B are very clear. Now part A has to be filed by each constituent entity of a multinational group. When I say constituent entity, it generally refers to a subsidiary of a multinational entity. It's a simple form. It just talks about who is your parent, and what accounting period is followed by that parent, and what is the name of the group. There are about 10 questions asked, very simple ones, that needs to be populated in part A and has to be filed. Part A has to be filed irrespective of the thresholds for revenue and the international transaction, which is applicable for part B. Now part B says that if in the accounting year the consolidated group revenue exceeds 500 crore, right, and the aggregate value of international transaction as per books of accounts for the accounting year exceeds 50 crore for international transaction, or in relation to intangible assets exceeds 10 crore, then the part B becomes applicable, right? Now, assume a case where you have exceeded these thresholds. Your group turnover is greater than 500 crore, and the value of international transaction is exceeding, say, 50 crore. Or you have an international intangible transaction, which is, say, a payment of royalty, which will be, say, 10 crore. Then you have to adhere to the part B as well. Now, what is part B? What are the contents? We'll get into that. When has to be, what kind of submission one has to do? So the master file has to be filed by an entity which is falling within those definitions by the due date for filing the return of income, which in our case is, especially if you have a TP, it will be November 30th, right? There is a form prescribed for that, which will be form 3CEAA. Yeah. So these forms, I admit, is slightly confusing. 3CAB, AC, and all. I always get confused with that. I just keep that simple. Master file notification forms simple. Okay. And yeah, you have to file the master file by the due date for filing the return of income. And there is an option where if there are multiple entities in India, then one of the entity can nominate itself to be a representative of other entities and say that I will file the master file on behalf of all the entities, and that form will be form 3CEAB, simply notification form, which has to be filed 30 days in advance, which in our case should have been filed by October 31st. That designation, the notification form where you say that I am the entity which is going to file the master file on behalf of all others. And this notification can be filed both for part A as well as for part B. Right. Now, what will be the contents of master file? Okay, a lot of verbos here, but I'll just let you guys go through this the content for a minute. Right. So as you can see, it gives you a good overview of what the entity is into, what the whole group is into, right? You start with list of entities of the group, the holding structure of the group, then you come down to what each of those entities which have substantially higher products or performing higher functions, what those entities are into, their functions, assets and risk in a brief way you provide. Then you get into what kind of intangible properties are owned by that entity, who owns that, who develops that, who manages that, those information you will provide. And then eventually goes into what kind of intercompany financial arrangements you have. Interestingly, there are certain additional points when it comes to India. This is not exactly what the OECD prescribed, unlike in CbCR, where whichever country you go, the CbCR format is same. And that's the advantage of India can rely on the CbCR document filed in say US, because it's the same format which is there as well and in India as well. But master file, there are slightly few changes. We'll come into that. And then it talks about what kind of APAs that you have entered into, whether it's a unilateral APA or the bilateral APA, things like that. So it gives a good overview of the whole entity, who does what. Here in the last column you can see what are the additional requirements as per the Indian rules. Most of the requirements deal with the name and address. We have some fascination with the name and addresses, I suppose, which is not prescribed in OECD but specifically mentioned here. And I can tell you out of experience that for larger entities it's a humongous task to populate those names and addresses in the form. Especially when you have comma or some special characters, some of this time the system does not take those, so it's crazy. So then we have asked for the functions, assets and risk analysis of entities contributing at least 10% of IG's revenue. I think here it was 5% in all the cases. So major geographical markets or products, services. When it comes to intangibles, we have asked again the names and addresses of the entities which are involved in developing and managing the intangibles. Interestingly, in the financial arrangement, we have asked even the names and addresses of the unrelated parties. Suppose the overseas entity had an arrangement with, say, HSBC or some other bank. Those documents, those information have to be reported in the master file under the Indian requirements. That's where we see a lot of resistance from the taxpayers saying that why should I provide that information. Now again, the due date we just touched upon that. The 30th November is the due date for filing the master file, and if you have to file a notification, you have to file that notification 30 days prior to the due date for filing the master file, which is for 18 it was 30th October, 31st October. Who has to sign these master forms? It's essentially filed digitally. You basically generate an XML schema and upload that file. It has to be verified by a person who is competent to verify the return of income, which is more often than not either MD or a director. It will be filed electronically. It will be required to be filed with the DGIP, risk assessment and procedure for its XML file. It also gives an option to upload the file itself, the PDF file. I guess there is a limitation on the size of the file. I think it's accepted only 50 MB file or something it accepts. What one can do is, what we have seen is, there are master files which are like 400 pages, 300 pages master file and all. And the XML, the electronic sheet which is there, that has a restriction on the content of that. So I can't actually put whatever written in the master file in that XML file. So what we can do is, we can refer to each paragraphs or the sections in the master file and upload the master file. That seems to be feasible, but we have to see how it is going to be looked at by the tax authorities. But the alternate is you can write a summary of those activities in the electronic file and then attach the master file, full set of master file as well in the system, so that there is the document is at least there is a summary and there is a full set of information available. Hefty penalties for non-compliances. Non-furnishing of CbCR by Indian parent or the alternate reporting entity resident in India each day up to a month from the due date, 5,000 per day. Beyond a month from the due date is 15,000 per day. Continuing default will be 50,000 per day. So it is a day-wise penalty. And non-submission of information during the audit, essentially. Beyond the expiry of the period for furnishing the information, 5,000 per day, and then continuing default will be 50,000 per day. And in instances where there is inaccurate information provided, which is with knowledge, you know that there is information, but you hidden those information, then it will be 5 lakh. It's necessary to do the master file as well as the CbCR. So yeah, it's a hefty penalty for non-furnishing of information, providing the right information, and during the audit, if you don't provide the information, they ask again, there is a penalty. And the question comes, all these are fine, somehow we will put together all these things, but how is it going to be looked at by the tax authorities, right? So that connects to our earlier discussion that we so far in the transfer pricing assessments we looked at only the tail of the elephant. With this information, you are actually having a full elephant of in front of you in the before the tax officers, and then you can imagine what kind of assessment is going to be down the line 2 years. So this is where we are today when it comes to transfer pricing. We started with a simple Form 3CB transfer pricing documentation, looking at applying PNMM and looking at only one aspect of the transaction. What we see is the amount of information that we are going to provide to the transfer pricing officers is going to increase year after year. Couple that with the risk-based assessment where your case is not going to be referred based on the value of international transaction but based on the risk analysis. That risk analysis is based on this information that you have filed, which is electronic filing. Easy to do a data analytics based on on the electronic filing. So you can see a picture where your assessment, your transactions are going to be analyzed in much depth. You will have to maintain your documentation probably much stronger and have a reason for taking a particular stand in your documentation and document that, because these things will come up after 2 years. Probably you would have forgot, people would have left. So better to be aware of these things and just be prepared for that. So that's essentially what I have as far as master file and CbCR are concerned. I have not touched much deeper into it. I just gave you a broad overview because the much deeper it goes with so many forms, the chances are that everybody will get confused. I will leave it to you. Have these thoughts. I have broadly outlined how it works. If you are interested, you can still read Action 13 of OECD guidelines. That's a pretty interesting document. Read Action 8, 9, 10 of OECD guidelines, which essentially talks about how one has to do a functional analysis and look at the transactions and all. So these two documents will be really helpful in your pursuit to be a transfer pricing specialist. If you have any questions, you can ask me. Otherwise, it's essentially what I have as far as TP compliance is concerned. So I hope you found this useful, and thank you very much for taking your time out during the Diwali time and coming over here. And happy Diwali to everyone. Thank you.
On behalf of all the members and on behalf of panel bench, I thank you, sir, for coming over here and giving an excellent presentation. Big round of applause for both the speakers. As a token of gratitude and also for sparing his valuable time for the institute, I request C.A. Parmeshwar to kindly come forward and present a memento to our speaker, C.A. Umesh Rao. I also request C.A. Parmeshwar to kindly give a gift voucher to C.A. Ruby Thomas. Big round of applause.